Now let's take a look at the bigger picture. Matthew Johnson is with us, president owner of Johnson Wealth and Income Management. Thank you so much for being here. Recession, you think we're already in one and it's only going to get worse? You don't see much improvement.
Well, thank you for having me on again, Nicole. And yes, it's absolutely official. We are in a recession. When we have 2 quarters of negative GDP and we see everything that's going on, I mean, you can't help but really look at the facts and look at the fundamentals and realize that we are in a recession. Is it going to get better? I think it's going to get worse before it gets better. I think that this is kind of the process and the cycles that we see economically in this country. Right now, unfortunately, I don't really see any end in sight as far as the Fed's raising interest rates. And unfortunately, I know that I see a lot of concern or a lot of input from the actual government, the type of leadership that we need to be able to address these high inflationary times. I'm just not seeing that leadership in that area.
And at this point now, what's interesting is I had a great conversation with the CEO of one of the firms here on Wall Street. And I said, you know, it's unbelievable what we're paying for everything, inflation. And I said, in recession and the markets are just testing new lows. And he said it's only going to get worse. He agrees with you. He just doesn't really see any reprieve. So that being said, I mean, there must be opportunities that are beginning to pop up, right, for a long-term player, right?
Oh, absolutely. When we think about what happens every time that the Feds raise the interest rates and they make the interest rates go up, and we see the slowdown on sales, and we see these companies that are going to be coming out this month, and they're no doubt going to be lowering their projections. They're going to be taking and showing how their business is contracting because of lower sales and supply chain issues. It's going to be taking risk premium, and it's going to be increasing that. And as those risk premiums begin to gap out, they get wider, that creates exceptional opportunities for long-term investors to be able to grab some really, really good names. Now, that doesn't mean that those names aren't going to continue to fall, because I do believe that it's going to be that way. But that's why you want to chip away at these things. You want to be able to dollar cost average into them, as it were, because we don't know from day to day what's really going to be happening. But we have to have a long-term outlook. We have to have a long-term objective, and we've got to stick with that.
What kind of names?
Well, when you think about right now petroleum, I'm just going to use petroleum for just a minute. You know, Ben was on just a minute ago, and he's talking about what's happening within the petroleum industry. Well, when we look at what this administration said initially when they were trying to vie for presidency, they basically vowed and said, listen, we want to reduce the consumption of petroleum by at least 10%. Well, when we think about what the government is now threatening these petroleum companies with, saying we're going to implement windfall taxes and we're not going to allow you to be able to drill in natural resources and so on and so forth, I don't think that there's much of an incentive for the CEOs of petrochemical companies to actually invest in infrastructure and try to increase the volume. So when we look at this company or the industry in general, we know that their profits are very, very strong. They're going to continue to stay strong for some time. They're going to pay good, strong dividends. Additionally, we need to be thinking about large cap companies and doing our due diligence, looking for companies that are free cash flowing, companies that have gone through recessions before, that are paying that 3-4% in dividend, because that's going to help you tremendously reduce your risk, and it's going to provide you the income that you need so that you can continue to invest or continue to spend during these more expensive times.
Is there a sector you would avoid? I mean, you just finished talking about petroleum and the moves that we're seeing there. Is there something that you would stay away from at this point now, because you have a rising rate environment likely, as the Fed is likely to move higher at end of July and September?
Well, there's two in particular that I think are just kind of glaringly obvious. The first is going to be the auto industry. When we look at automobile sales and we look at stock prices within auto manufacturers, you know, they've absolutely been slammed 50%. When we think about cryptocurrency, I mean, it's a rough ride. We're seeing a lot of volatility within cryptocurrency. Remember, it's a commodity. It's something that, yes, may come to fruition. It definitely is going to grow into itself. And right now, it's going to be a wild ride. There's individual investors that are thinking, well, maybe we should go ahead and, you know, invest in bonds, but they're not investing in quality bonds. They're putting their money into junk bonds. And if we look back historically, we see the junk bonds have had the worst year in 20 years. They just got slammed. So I think that there's still a tremendous amount of risk there. So we've got to be really, really careful to analyze exactly what we're investing in, knowing that these are very tumultuous times and is likely to get a little bit worse before it gets better.
So it's interesting that you said that about crypto. You just don't like the uncertainty of it all. And obviously we've seen crypto, I mean, I don't know if you want to use the word crash, but it went from almost 70,000 to 20,000, right? You just wouldn't put it in clients' portfolios, and not even through MicroStrategy or Square or something like that. You're just staying away from it altogether?
Well, you have to kind of understand my business model. I'm working with people that are 50 and over, people that are much closer to the distribution stage of their life, and they're looking for income. They're looking to reduce their risk, not increase the risk. It's okay if you want to be able to, diverse with 5% of your portfolio and put it into crypto and take the bet on that. But this is like investing in an illiquid, non-traded REIT. You don't know if you're going to get your money back or not. You don't even know if you're going to get paid. So we have to be very practical. We have to be very purposeful with how we invest our money. We need to be looking for, okay, what is going to likely be able to weather the storm the most? What's going to be able to prove that it's gone through recessions before and it's been able to still continue to be in business after the fact? And so this is a great deal of logic. It's a great deal of practicality. Today, Nicole, we've got so much fear. We got so much panic going on. There is so much volatility being caused through emotion. We've got to go back to the fundamentals of investing.
Right. Understood. Matthew Johnson, nice to see you, president owner of Johnson Wealth and Income Management. Thank you, Matthew.